Hey everyone, welcome to the KE Report, another daily editorial. This time chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. We'll recap the jobs data, the market reaction on the back of that jobs data, especially tied in with currency moves and the potential for what it means for the Fed meeting and maybe a rate cut, maybe a bigger rate cut again coming up. Mark, let's start off with jobs data. Like, there wasn't a whole lot of surprises in this jobs data. The payrolls grew by a little above the estimate, about 7,000 above the estimate. The unemployment rate rose by 1/10, so 4.2%. We did see some wage gains. The hourly earnings rose by 0.4% month over month. That was 1/10 above expectation. So again, expectations broadly in line with where that jobs number came in. But a lot of the reasoning I'm reading about is that the unemployment rate went up, and that's why people think that the Fed might be cutting rates again. Mark, what was your takeaway from this jobs data?
Yeah, sure. Just to clarify, the Federal Reserve won't meet until the 18th. We do have other central banks that meet next week. But the economic data in the US still seems to be fairly robust, pointing to, say, close to 3% growth this quarter. The jobs data to me was a bit stronger than expected, not so much because of the headline number and non-farm payrolls, but the two back months were revised up by another 56,000. So typically the revisions are in the direction of the underlying trend. And as you know, the revisions have been lower for quite some time. The other thing that seemed promising is the jump back in manufacturing jobs by about 22,000. That's important for the U.S. industrial sector. But then I think what's really happening is that we've had some weak jobs report last couple of months, and mostly they were distorted by weather, storms, industrial actions. And so this is the first, I want to say, sort of clean read, but there did seem to be a big discrepancy. You mentioned the unemployment rate ticking up to 4.2%. That was surprising. What makes it most surprising to me is that the labor force participation rate ticked down. That is, fewer people were participating in the workforce, yet the unemployment rate went up. So to me, that's a bit of a yellow flag that something might be going on. And what we see when we drill down, as you know, the jobs data comes from two surveys, household survey, and that generates the unemployment rate. That lost jobs. Several 100,000 jobs were lost in the household survey, but we saw a couple 100,000 jobs gained in the establishment survey. It's not unusual for these two surveys to diverge, partly because of definitions. How when you call up the household and you ask them, "Did you work this week?" Uh, if they were on strike, they'd say no, but that doesn't count as unemployment. And so, just give you a quick example about why there could be a reasonable discrepancy between the household survey and the establishment survey without anybody lying or exaggerating. People are just telling from their perspective. But I think you're right though too that the market took this and the unemployment rate, and the knee-jerk reaction was to increase the likelihood that the Fed cuts at the end of the meeting on December 18th. Now, what's the next key piece of data for the U.S. is going to be that CPI in the middle of next week. The consensus, I should say, the median forecast in the Bloomberg survey is for an uptick in the headline rate, even though the core rate will stay steady at around 3.3%, barring some rounding numbers, how they round it up. So I kind of thought that the employment number and the CPI number will be enough to favor a pause in Fed policy. They're still going to be in an easing mode, but I thought that the data between the jobs data, the CPI next week, will help encourage this view that, as Powell said it earlier, that they can afford to be more patient, that the economy is doing better than they expected.
Yeah, Mark, and a couple other the Fed heads had come out and said something similar over the last month or two that they're not forced into having to make a cut in December. But of course, the market is always forward looking and looking at any data it can latch onto where they can get encouraged by the cut. But the market's been a little trigger happy for the last 2 years about whether it's hikes or cuts, what was going to happen. So I think we need to kind of read in between the lines is what the Fed is actually saying versus what the market's expecting. But when you look at what happened in interest rates and currencies, how do those moves, I guess, confirm one way or the other? Is there going to be a cut or a pause?
Well, I think this is the interesting thing because of what happened in September. You remember in September, most of us were looking for a quarter point cut. And we had that CPI that was weaker than expected. But the CPI came during a quiet period when the Fed doesn't speak to the press. And so what did the Fed do? Many of us suspect that the Federal Reserve, perhaps even Chairman Powell, planted a story in the media to prepare the markets for a 50 basis point cut. So here we are, December, and so the same frame is taking place. We're going to get the CPI during a quiet period with the Fed. With such strong odds being priced in the market for a Fed cut, they have to do something to push back against it, or they'll deliver the cut. And so I'm going to be watching carefully in this next week during this quiet period for the Fed if there's these press leaks to signal one way or the other. But I think this is the dilemma for the Fed. They have a quiet period while the CPI, one of the most important macro releases during the month, is released.
What about the impact of other central banks that sound like they're going to continue to cut rates? We all know that it's also kind of a comparison game too, where other central banks are cutting rates, not that the Fed follows, but then that does expand the discrepancy between what rates are in the US compared to the rest of the world.
Yes, I think that's part of the reason why I'm still thinking that the dollar can firm up further. Partly when you think about what's going to happen next week, let's just go through some of the central banks. There's Bank of Canada meets, the ECB meets, the Swiss National Bank meets, and what's going to happen, I think, is that also the RBA meets. So we got the G10 central banks meet. The RBA is going to be on hold. They've told us they'll be on hold. What's ironic to me is that the Aussie has been hit pretty hard. It's been harder hit this week than the New Zealand dollar, and New Zealand's in the middle of a huge easing mode. The Aussie's also fallen more than the Canadian dollar, and Bank of Canada meets next week, and the market favors a 50 basis point cut from the Bank of Canada. But we also get the ECB. The market feels very confident of a 25 basis point cut from the ECB. The Swiss National Bank is a bit more interesting, perhaps. Their deposit rate is already at 100 basis points. That's how low it is. The markets are pricing in more than a 50% chance that they cut by 50 basis points, that they have cut in half their deposit rate. I think that's a bit aggressive, but the euro is very weak against the Swiss franc, and it really was the Swiss franc's strength earlier this year, back in February and March, that let me take a low odd view that turned out to be right, that the Swiss National Bank was going to cut in March. And really more driven by my understanding how important they see the exchange rate. So once again, even though I think that the Swiss National Bank would want to be slowly cutting rates, if you're at 4.75% and you cut rates by 25 basis points, that's one thing. If you cut by 50 basis points, that's one thing. But if you had 100 basis points and you cut by 50 basis points, that's much bigger of a deal. So I think they want to tread carefully, but the weakness of the euro might be giving them little choice. But in any event, the point of all this is that next week we'll see 3 of the 4 G10 central banks cut rates with the RBA on hold. Bank of Canada may cut 50, especially after today's uptick in not only unemployment, but also the drop in wage growth. ECB 25. And so my guess is that this is also like a supportive thing. Like you say, interest rate differentials have narrowed a little bit as U.S. 2-year rates have fallen. But tell me that these other central banks are going to be cutting rates, that interest rate differential may widen again and be dollar supportive.
Well, Mark, let's get into the currencies. Let's talk about the dollar, but let's look at some of the other currency pairs versus the dollar. With all these central banks cutting and all this monetary policy, how are you looking at the currency market?
Well, this week I'd say that the dollar has been roughly it's been mixed, and I think that people are trying to we've had this employment data today, and then we've got the CPI next week. But at the end of the day, most of the currencies were a little changed. The yen plus or minus 0.1%. The euro 0.25% lower. But the big losers, Norway, Australia, basically the Scandies and the dollar block, were really led to weakness, and they were off by 0.8 to a little bit more than 1%. So it really tells you a little bit about this, where the divide is. The major currencies a little bit have been hit a little bit less. But having said that, the dollar still seems relatively strong. And you think about sometimes they talk about the dollar index, and that still looks fairly strong to me. Even though we made a new low today, since the middle of November, we really reverse and we're going to close strongly today. And it looks to me like we're going to have a good week next week for the greenback.
So, Mark, what is the path of least resistance for the dollar then? Because it was ripping higher in October and November. It turned over a little bit in the tail end of November, has been on arguably a bit of a downtrend. But as you said, if it holds the level that it touched today and rebounds, I guess follows through next week, then it's very much just in a range. So, what is the path of least resistance for the dollar in a longer term sense in your eyes?
That longer term, I think, is a bit tricky. In the very near term, I can see it having another leg up. I think it needs to get above 107. If it doesn't get above 107, and I think we begin getting more sign of maybe a distribution top, or maybe even a head and shoulders top in the dollar index. But I think that the underlying idea that people haven't given up on, even if there's profit taking during it, is that Trump's policies are going to lead to higher inflation, higher U.S. interest rates, and a stronger dollar. Even though he wants to talk the dollar down, you can't always get what we want in the sense that you got like conflicting thrusts in effect. So I'm still thinking that in the big picture, the dollar is going to be headed lower. That the policies that the U.S. pursues, the weakening of the economy, I think in next year, I would still have the dollar moving lower. But first, I can see another push higher in the dollar. So maybe it's a couple of weeks long up move in the dollar. I think we have to get through the Fed, and even if the Fed were to cut 25 basis points, it'll be coming like we've talked about at the tail end of other central banks cutting, some of them perhaps even more aggressive than the Fed. And when you look into next year, when the Federal Reserve meets on the 18th, they'll update their summary of economic forecast, the dot plot. And I think that we'll see that the Federal Reserve anticipates cutting maybe twice next year rather than the 4 times that they suggested in September.
Well, Mark, in addition to the dollar getting strength after some of the Trump policies were unveiled, there's another currency we've not talked about, and it's a cryptocurrency, Bitcoin. It's also been strengthened by some of the calls for the Trump administration to have a strategic crypto reserve, also having Elon Musk featured so prominently in the wink to the crypto market with the Doge, the Department of Government Efficiency. There's been a lot of speculation in that asset class, and as another currency or a competing currency, Bitcoin up over 100,000 again, up to 101.4 at this time, the recording. So it's interesting to see a continued push into Bitcoin. What do you make of that movement?
I think Powell had it right when he spoke to the New York Times earlier this week. Federal Reserve Chair Powell said that crypto, and Bitcoin in particular, I think, is not so much a rival for the dollar as it is to gold. And that's because the function of dollars, you think about it, dollars being used to buy goods and services. It's being used to buy U.S. Treasury bonds. Crypto is not. So in this respect, I still don't think crypto is really money in the way economists define money. It's not used as a transactional vehicle. Things are not priced as a unit of account. Things are not priced in crypto. But it's drawn a lot of interest. $100,000 is nothing to sneeze at for something that began at like practically no value whatsoever. Say, I don't know what it was, 10 years ago or so. So I think that what's happening now is that Trump has surrounded himself by people, including someone who's going to be like his czar of crypto. And I think this is helped fuel this speculative fever for it. It doesn't seem like it's over. People are expecting the regulatory environment to be much more supportive of the financial innovation in the crypto space. Still, I still wonder I can see how in a country that you have capital controls like China, or where you have an unsound banking system, perhaps like China, I can see why people would want to use crypto. I don't really see much of a use case in the US except as a financial instrument and this FOMO, the fear of missing out. You spot a trend, it's moving higher, sharply higher, dramatically. Everybody's talking about it. How come you're not on it? And I think that's what's driving a lot of the interest.
Hey, fair enough. FOMO can drive a lot of different markets. And look, Bitcoin was created just over 15 years ago, and it's already at $100,000. It is quite spectacular. But Mark, what about this whole concept of countries, big tech companies, even cities using crypto or including crypto in some sort of their strategic reserve? It's been brought up now more and more, especially after Trump got in. How significant is that in that overall crypto narrative?
Yeah, it's kind of exciting in a way, right? Imagine that corporations put their spare cash in crypto. And I think a couple of companies have tried that. And then countries. I think El Salvador has experimented with it. I just don't see it happening in the US. Partly, I'm not sure what we gain from it. So we say, well, what are our reserves in now? Why do we have euro reserves or Japanese yen reserves or sterling reserves? Is it for something that crypto can't do for us? And I suspect that's the case. Secondly, I think that companies, so I talk, in my career, I've talked to asset managers, corporations, and in my latest life, I've been talking mostly to corporations. And I haven't found a corporation that I've talked to personally that is eager to put crypto into their corporate reserves. Partly, the corporate treasurer tells me their job is to manage risk. And what happens in a multinational, right? You've got your revenue in one currency, and you might have your costs in a different currency. That's what they have to manage. And they report into dollars. They've got to convert all that into dollars, even if it's just a paper and accounting function. So what are they going to do? Why would a corporation want to take on a different risk? They have neither expenditures nor revenues in crypto. So why would they want to take on crypto onto their books? Say, well, to make money. And I'd say, well, maybe, but two things. One, what if they lose money? And secondly, that's not really the function of a corporate treasurer's. The idea of a company is to make a product or a service that's competitive. It's not to make money manipulating financial variables. Though of course sometimes that happens. I just don't think it's really a generalized practice, and especially from small and medium-sized companies.
All right. Well, Mark, we'll wrap it up here. Interesting comment. We got a little bit more off on the crypto space, but you know what? That's been also dominating my news feed more than a lot of other sectors, and I think rightfully so. Look at the price moves, look at how much money has been made, and quite frankly, it's being talked about in politics too, which is shocking in my eyes. But hey, this seems to be the trend right now, so it is noteworthy to talk about. Again, Marc Chandler, managing partner at Bannockburn Global ForEx and editor of the Mark II Market blog, which I will link to in the show notes. Mark, great chatting with you. I hope you have a great weekend.
Thanks. Good luck to everybody.